Hello, good day. This is Dr. Don Charles. Welcome to my course, Day Trading Stocks. In this lecture, I will provide you with an example of how to apply technical analysis when you want to trade stocks. So the outline of this lecture includes engulfing pattern. I will show you how to trade the engulfing pattern, harmonic chart patterns, and the Bollinger Band relative strength index price crossover strategy. Now let's go to TradingView. In TradingView, I have selected the stock LMND, Lemonade Inc. Now we are going to trade the bullish engulfing chart pattern. Recall in the bullish engulfing chart pattern, we see two candlesticks. First, we see a red candlestick, then we see a green candlestick. So let me show you. This gives us a bullish engulfing chart pattern. We see a red candlestick, then we see a green candlestick. Now let's look for a bullish engulfing. This is a bullish engulfing here. Well, somewhat of a bullish engulfing. We see this is the red candlestick. This is the body of a red candlestick. This is the body of a green candlestick. The body of the green candlestick overpowers the body of the red candlestick. Now, when I trade bullish engulfing candlesticks, I typically look for 3 to 4 red candlesticks first, forming a pattern, before it gives me a signal for a bullish engulfing, meaning this, that I need to see about 3 to 4 red candlesticks first, then I need to see a green candlestick that overpowers the body of a red candlestick. So we see here, 1, 2, 3, 4, 5. We see 5 red candles, then we see 1 green candle, and the green candle overpowers the body of the red candles. This gives me a bullish engulfing. This green candle here overpowers the body of the red candle. So this tells me that the price of the asset might change direction, and was going down previously and will now go up. So I'll place an order to buy at the end of this candlestick right here. I'll place an order to buy right here. And if we bought this asset at this point right here, we can see that the next direction for the price to go was up. The price went all the way up right here. So let me write in. This was a bullish engulfing occurring right here. We can see another bullish engulfing occurring right here in the sense that this is a red candlestick. This is the green candlestick. The body of the green candlestick overpowers the body of the red candlestick. So a bullish engulfing occurs here, but typically I trade bullish engulfings when I see 3 to 4 red candlesticks first, then I look for the bullish engulfing chart pattern. So although the bullish engulfing chart pattern occurs here, I would not take this trade simply because I did not see 3 to 4 consecutive candlesticks first that were red before the bullish engulfing chart pattern appeared. Mind you, if you took this trade here, this would have been a win, but this would have been a small win. This is another bullish engulfing chart pattern occurring right here. We see 1 red candlestick. We see a green candlestick. The body of the green candlestick overpowers the body of the red candlestick. We see the price of the asset went up, but it's relatively a small win. I would have taken this trade here because we saw 1, 2, 3, 4, 5, 6, 7, 8. 8 red candles. My criteria is for there to be 3 to 4 red candles first before I see the bullish engulfing chart pattern and take a trade. So this is a bullish engulfing chart pattern. This is a bullish engulfing chart pattern. I would have taken this trade and I would have taken this trade. I would not take this trade because there was not 3 to 4 red candlesticks before the bullish engulfing chart pattern appeared. Mind you, all these trades would have been winning trades, but these trades would have been very small wins. So let's look for another bullish engulfing chart pattern. This is a stock here, IGT, International Game Technology. This is a bullish engulfing chart pattern right here. There was a red candlestick, and then there was a green candlestick. The body of the green candlestick overpowered the body of the red candlestick. So the price of the asset went down. Then there was a big green candlestick. The body of the green candlestick overpowered the body of the red candlestick. There were 1, 2, 3, 4 red candlesticks. My criteria is for there to be 3 to 4 red candlesticks before the bullish engulfing pattern for me to take the trade. I would have take this trade here. I would have go long at this point here. So when I go long at this point here, I would have place a stop loss just below the wick of the red candlestick, and then I'll try to ride this up. This would be a very big win. So if we take this trade here, we can ride this all the way up. So let's say we place the stop loss here. We place the stop loss just below the wick of the red candlestick. And we enter the trade to go long right here at the close of the green candlestick. Now, using this win to loss ratio, we can put the target profit right here now. However, if we just leave the trade open and let it run, watch how much, what the magnitude, or what the extent to which this profit would have grown. If we had left this trade open, this trade would have run all the way up, quite up here. So if we took a loss, this would have been loss here. But if we took a win, this would have been the win here. A very big win right here. And this is how I trade financial assets, in the sense that I try to make the size of my win larger, significantly larger than the size of my loss. So if this is the case, if on average, like let's say I take a win and my win is like about 10, and when I take a loss, my loss is about 2, then I'll be net profit of roughly about 8. If I took 2 trades and one trade was a win and one trade was a loss, the trade that was a win was so large, it will be more than able to compensate or cover the amount of money I would have lost in the losing trade. This is how I trade. I trade with a very good reward to risk ratio. I tend to trade with a reward that is about 1.5 to 2 times greater than my loss. I tend to prefer a reward to risk ratio that is greater than 1 to 1, in the sense that I want the size of my reward to be greater than the size of my loss. So I tend to prefer a reward to loss ratio of 2 to 1, 3 to 1, 4 to 1. I want the number, the reward, I want the reward to be very big. I want the size of the reward to be greater than the size of my loss. So if this is the case, then I don't need to win every trade. I could win half of my trades. I could win 50% of my trades. If I win 50% of my trades, this is not a problem, because when I take a win, the win will be so large, the win will more than cover or more than compensate the loss I would have taken. And this is what you need to do when you're trading. Some people think they're trading, and I think they think that they need to win every single trade. You do not need to win every single trade to be a winner. You do not need to win every single trade to be a successful trader. You need to have a very good win to loss ratio. The size of your wins need to be greater than the size of your losses. Let me show you a next engulfing pattern. This is an engulfing pattern right here. This is an engulfing pattern right here. This is a bullish engulfing pattern here. We see the red candle, we see the bull candle, the green candle. The body of the bullish candle is greater than the body of the bearish candle. The body of the green candle is greater than the body of the red candle. We see 1, 2, 3, 4 red candles. Then we see one bullish candle. The body of the bullish candle was greater than the body of the last bearish candle. This is a bullish engulfing, and I would take this trade to go long. I would take this trade to buy. Why? Because it meets my criteria. There were 3 to 4 red candles before the bullish engulfing chart pattern appeared, and I would take this trade. So if I take this trade, I'll buy wrong here. I'll put the stop loss just below the wick of the red candle. And let's see how this run. This will be a very easy trade. This will be a good win. So the price will go all the way up here. Now, if we held this trade, we could have hold this trade all up to this point right here. But more likely than not, I would have hold straight up to this point here, and I would have take up this profit about here, because this was an area of potential resistance. So I'll be looking for this area I was looking for this area for some form of retest. So I was expecting the price to go up here, bounce off, come down, and then go back up. So I would have tried to take a target profit here if I implemented a trailing stop, meaning that if I move the stop loss from this point here and move the stop loss into a profit position, I would have waited to see if this broke resistance. And we see that the price didn't break resistance. So if the stop loss was moved from this point here, and put the stop loss somewhere around here, so, and wait to see what will happen. And the price would eventually incur a pullback and hit the stop loss. So this would still be a winning trade for me. We see a bullish engulfing occurring right here. This is the red candle. This is the green candle. The body of the green candle overpowers the body of the red candle. We see 1, 2, 3 red candles. Then we see 1 green candle. So I would have taken this trade here. I'd place a stop loss just below this, just below. While here, the wick of the red candle is below the wick of the green candle. So I would place the stop loss below the wick of the green candle. And I'll wait to see what happened. And this was the target profit. The price of the asset would have hit the target profit. This would have win profit. So this was a winning trade. I just had to wait a few days and see what. This is one of the reasons why I often practice swing trading and position trading, in the sense that sometimes you enter a trade, a day trade, and it goes into profit. But if you try to close the trade within the same day, yeah, you'll get a profit, but the size of the profit is not as much as if you hold for a few days. Now, when I trade, I try to maximize my wins and I try to minimize my losses. So some traders lose because they close winning trades too early and they hold losing trades for too long. I try to hold my winning trades and I try to make my winning trades grow. In other words, if I in a trade and I think the profit could grow to a larger profit, why should I close the trade? I let the profit run, let the profit grow. I want to maximize my profit. I want my profit to become as large as possible. So if I am in a winning trade, more often than not, I let the profit run. And we can see here, if I let the profit run, the profit could have grown to this point right here. Likewise, when we're trading, we need to find a way to minimize our losses. I placed a stop loss here. So if the trade moved against me, it would have closed in this loss right here. Now, when trading stocks, when trading any financial asset, you should trade with a stop loss. When you're trading, you do not have a crystal ball. So there's no indicator that will be 100% accurate in telling you the direction the asset will move. In other words, no indicator, no technical analysis tool, no fundamental analysis, no tool that is available on the market will be 100% accurate. Some trades will be wins and some trades will be losses. If anyone tells you that they trade financial assets and they win 100% of the time, they are lying. You will take some wins and you will take some losses. No indicator will give you 100% predictive accuracy. Sometimes you will lose. However, when you lose, you do not want to lose all your money. How does you do that? You manage your risk. You manage your risk with a stop loss. So if the trade moves against you, it can close here and it will minimize your loss. So if this trade went against us and if the price went down, it will close right here and this will be a small loss. However, if the trade moves in our direction, it will move all this way and we will take a profit and it will be a big profit. If we take two trades, one is a loss and one is a win, we would still be a winner overall because the size of the winning trade would be greater than the size of the losing trade. This is how we trade. We trade with a good reward to risk ratio. We want the size of our wins to be greater than the size of our losses. We are implementing a strategy, but at the same point in time, we need to manage our risks. I want to emphasize again, You need to manage your risk. If you are trading, you need to trade with stop losses and you need to manage your risk. You need to minimize your losses. If you do not minimize your losses, if you do not manage your risk, you will not be a successful trader in the long run. You need to trade and manage your risk, implement a strategy and manage your risk. This is what we are doing. We are not gambling. We are implementing strategies to maximize our gains, and we're implementing strategies to minimize our risk. Let me show you another stock here. This is a bullish engulfing occurring right here. This is a bullish engulfing. So we see the bearish candle, we see the bullish candle. The body of the bullish candle overpowers the body of the bearish candle. We see 1, 2, 3 bearish candles, and then we see one bullish candle appearing, and the body of the bullish candle overpowers the body of the bearish candle. This is a bullish engulfing. I would trade this bullish engulfing. Why? Because it made my criteria in the sense that I tend to want to see 3 to 4 bearish candles first before implementing a trade to go long. So I would go long here. I'll place the stop loss just below the wick of the bullish candle. Now, generally, I prefer to place the stop loss below the wick of the bearish candle. However, the wick of the bullish candle was below the wick of the bearish candle. The wick of the green candle here is lower than the wick of the red candle. So because of that, because the lowest price was in the green candlestick, then I would place the stop loss below the green candlestick. And this is the target profit, and then I'll wait and see. This trade goes into profit. We see here that if we left the target profit at this area here, this would be a profit. However, if we let this trade run, we could have gained all up to here in profit. Now, what I would have done, I would have just taken about this area in profit and close the trade and I ran away with the market very happily. However, if we left the trade open and let it run, we could get all here in profit. Mind you, I expect the price of the asset to go up even higher than this, because although this is a resistance, we see that the market is trending up. This is a 50-point moving average that is acting as some area of support, and the price of the asset is just bouncing off support. This is dynamic support. Dynamic support is support that is not static, meaning that support that changes as the market changes. If we use a trend line to draw support, the support will be static. However, if we use a moving average to draw support, it will be dynamic support, and as the price of the asset moves, the support would move. Here we see that the moving average, the 50-point moving average, is acting as support, and the price is bouncing off support, and the price is in an uptrend. We see the price of the asset, the price of the stocks, CCS, is above the 50-point moving average, suggesting the price is going up. This is a good trade, and this is a good win. Now that I have shown you multiple bullish engulfing chart patterns and how to trade the bullish engulfing chart pattern, I will show you the harmonic chart pattern. So in my course, A Practical Introduction to Day Trading, I went into detail about harmonic chart patterns. Harmonic chart patterns are reversal chart patterns. They show that the price of the asset will now move in the opposite direction, meaning that if the price of the asset was going up, a harmonic chart pattern forms, and then it suggests that the price of the asset will go down. These are the popular harmonic chart patterns. We have the Gartley chart patterns, we have the crab chart pattern, we have the bat chart patterns, we have the butterfly chart patterns, and we have the cipher chart patterns. These are just some of the common chart patterns. Now, the Gartley chart pattern was the first harmonic chart pattern that was developed. It is also referred to as the Gartley 222 pattern, as it was found on the page 222 of H.M. Gartley's book, Profits in the Stock Market. Generally, harmonic chart patterns tend to look like an M, and they tend to look like a W. Now you can use Fibonacci ratios to estimate the turning points for the harmonic chart patterns. However, you don't need to do that in detail, as there's software that can do this for you. So let me show you how the harmonic chart patterns appear on TradingView. Let's look for a harmonic chart pattern. We see a harmonic chart pattern appearing here. Actually, we see multiple harmonic chart patterns. This is a harmonic chart pattern here. 1, 2, 3, 4, 5. Well, this is a harmonic chart pattern occurring here. So this was a harmonic chart pattern. This suggests that the next direction for the price to go was down. This actually did occur because after the price of the asset reached this point at D, the price went down. We also see a harmonic chart pattern appearing here. It went from 1, 2, 3, 4, 5. The next direction for the price of the asset goes up. So since we're seeing this harmonic chart pattern appearing here, if we want to trade the stock, we want to buy the stock at this point right here. Now, I tend to trade harmonic chart patterns with additional price action analysis. I draw a trend line. I draw a trend line that is parallel. I draw a trend line that is parallel to this price movement here. I wait for the price to break this trend line. Then I want to see a retest of a potential area of support. So this is an area of support. This is a potential area of support. Support could be a zone. So I expect support could be a zone. So I expect this is a potential area of support. I expect this is some area of support here. Support could be a zone. How I know this is support? This is a low. This is a low. This area here is some area of support. So my first criteria is for the price of the asset is to break the trend line. So one, the price of the asset was about to break the trend line. I want to see some retest, meaning that I want to see the price of the asset come down, test support, and then go back up. So I want to see the price of the asset. So I want to see the price of the asset come down, test support, might test about twice, and then go back up. When I see that, I'll enter a trade to buy somewhere around here. So this is how I trade harmonic chart patterns. I wait for my first criteria, I wait for the harmonic chart pattern to form. Then I draw a trend line that is parallel to this area down here. Then I have some area of support. I wait to see a retest of support. And when I say a retest for support, I buy when the price is going up. Now, with regards to target profit and the stop loss, I will enter a trade here. I'll place the stop loss just below the area of support. So I'll place the stop loss here. And then my first target profit will be this area right here. It will be the neckline. But if you see here, the size of the win is smaller than the size of the potential loss. So I do not trade with these bad reward to risk ratios. So I would try for a minimum of this area of target profit. So this will be target profit 1, this area here. Target profit 2 would be this area right here, this other resistance. So target profit 1 will be this area of resistance. Target profit 2 will be this area of resistance. And I'll wait and see what happens as the price moves along. This trade will be a swing trade to a position trade. I expect this trade to hit my target profit in a few days to a few weeks. Maybe after 2 weeks to 2.5 weeks, this price can hit this target profit around here. So you'll have to wait. Let me give you another example. This is another stock. This is a harmonic chart pattern appearing here. So you see this harmonic chart pattern appeared like an M. What I'll do, I'll place a trend line here. I'll wait for the price of the asset to break this trend line. This is going to occur in a while. So you see here the price already breaking this trend line. The second criteria is for look for the area of support, and I want a retest of the area of support. So this potential area of support is around here. So I'll want to see a retest of support. So I'll want to see the price come down here, touch support, and go up. Note we already see one test of support here. So I want to see the price of the asset go down here, touch support, and go up. So I'll place an order to buy around here. My stop loss will be around here. My target profit will be this point here at point C. Mind you that the size of my win, my potential win, is greater than the size of my potential loss. So if this trade turns into a win, this will be the win. If this trade turns into a loss, this will be the loss. If I took two trades based on harmonic chart patterns, and one was a loss and one was a win, I would still be a winner overall. Why? Because the size of my win will be greater than the size of my loss. Note, I would trade with a stop loss. I'll place a stop loss here. Why do I trade with a stop loss? I do not want, if I place a trade and the trade end up being a loss, and that one loss to wipe out my entire account, I need to manage my risk. How I manage my risk is by placing a stop loss. I trade with a stop loss right here. I will place a stop loss right here. If you trade and you trade without a stop loss, you'll be gambling. You will not be managing your risk. You'll be taking risky trades, and all it takes is one bad trade to wipe out your entire account. Let me give you another example. This is a harmonic chart pattern right here. So you see the price went down, it went up, it went down, it went up. This is a harmonic chart pattern right here. I'll place my trend line parallel to this line here. And then I want a retest of resistance. So resistance is around here. I want a retest of resistance. Basically, what I want to do before I enter a trade, I want the price of the asset to go up here, touch resistance, and then come down here. And I want for the price to go all the way down, all the way here. So I'll place a trade to go short around here. Mind you, when the harmonic chart pattern was formed right here, it will be very good to sell at this point right here. However, how do I know that this point is actually a turning point? How do I know for sure that the price doesn't go all the way up here? I wait for the harmonic chart pattern to form. And for the harmonic chart pattern to form, there must be a turning point. And once I'm sure that the harmonic chart pattern has formed, I draw a trend line. I wait for the price of the asset to break the trend line. I wait for a retest of potential resistance. Here's the potential resistance. And then I place the order to go short right here. And I wait for the asset to go all the way down. Note this has not occurred right yet, so we have to wait and see what will happen. I expect this trade to also be a swing trade to a position trade, meaning that I expect this to go into profit, a big profit, in a few days. Let me give you another example. This is a harmonic chart pattern right here. The price went up, pull back, went up, pull back. This harmonic pattern look like an M. We can use the Fibonacci ratios to compute the exact turning points. However, you don't need to know how to compute the exact turning points. There's software that can do this for you. This is the harmonic chart pattern here. I draw a trend line. This is the potential area of support that I will compare retest. How I know this is the potential area of support? This was a lower low. This was a lower low. So here was some area of structure. Here was some area of support. 2 touch suggests that some area could be a potential area of support. 3 touch actually confirms it. So if we carry the line across here, we can see some areas of touch right here. So this is a potential area of support. So what I'll want the price of the asset to do, break the trend line, come down, touch support, retest support, then go up. I'll enter a trade to go long somewhere around here. I'll place the stop loss just below this point here. So here will be the stop loss. Well, this will give me a 1-to-1 reward to risk ratio. So I'll want a bigger reward than that. So I'll put my potential target profit at this area here, and I'll wait for the price to go all the way up. If this turns into a win, this will be a very big win. If this turns into a loss, it will be this loss. If I enter 2 trades, one is a win and one is a loss, the trade that ends up being a win will give me this size win. The trade that ends up being a loss will give me this size loss, and I'll end up being a winner overall. Why? Because the size of my win will be greater than the size of my loss. This is how you need to trade. This is how you trade as a successful trader. I manage my risk by placing a stop loss, and I try to minimize my losses. At the same point in time, I try to maximize my wins, and I try to trade with a good reward to risk ratio. I try for my wins to be greater than the size of my losses. And once I trade based on this, I will be profitable overall. So I will take some wins, I will take some losses, but the size of my wins will be greater than the size of my losses, and overall, I will be a winner. Let me give you another example. This is a harmonic chart pattern right here, but we missed the opportunity to buy. So the harmonic chart pattern was formed. This was the trend line we want to break. Let's see trend line somewhere around here. So you see the price of the asset broke the trend line. This was the area of resistance we wanted to test. We see the price of the asset went down. It went up, it tested resistance, and then went down here. This was a winning trade. So if we place a order, we'd place the order to go short. We place the order to go short somewhere around here. This will be the stop loss. The stop loss will be just above the area of resistance, and this would be the target profit. This would be a very good trade because the price went all the way down here. In fact, the market closed at this point here and then opened at this point here. So the market opened at a lower price than what it closed at, and then the price went all the way down. This was a good trade. This was a winning trade. So if we took this trade as a win, we could get all here in profit. So all here was the target profit, the potential target profit. However, if this trade turned to a loss, the size of the loss would be only this loss here. That would be this area right here. So what's the size of the win? This is the size of the win. This is the size of the loss. So when we trade like this, we will be a winner overall. Let me give you another example. This is a harmonic chart pattern right here. Well, we missed this trade, but nevertheless, a harmonic chart pattern did appear. So this was the trend line. We wait for a retest of the market. We wait for a retest of resistance. We see some slight retest of resistance. Now, generally speaking, I would prefer for the price of the asset to break the trend line first and then have a retest. But we see that didn't occur right here because the price of the asset broke the trend line and then went all the way down. But what I wanted for the price to do is break the trend line, then retest resistance, and then go down. So basically what happened is that I might have missed this trade in the sense that because the retest didn't occur, I will not take this trade because I will wait for the price to go up here, hit resistance, and then come down here. So I'll place the order to sell I'll place the order to sell somewhere around here. I'll place the stop loss around there, just above resistance. And this could be target profit, or target profit could be about here, sir. However, this order would not have been filled. Why? Because I was waiting for the retest to actually implement the order. However, I didn't get the retest. When the price of the asset broke trend line, it went all the way down. So this was a potential winning trade, but because the order wouldn't be filled, I would have missed the opportunity to take this win. So the next thing I want to show you is the Bollinger Band. The Bollinger Band Relative Strength Index Price Crossover Strategy. So I need 3 indicators to implement this strategy. I need a Bollinger Band, I need a moving average, and I need the RSI. So let me pull up the indicators. Bollinger Bands. I already have the moving average. So let me change the moving average from 50 point to 8 point. And let me get the RSI. This was a potential area to buy right here. We see the price of the asset went outside the Bollinger Band, size 1. We see the RSI went into oversold conditions, that is 2. And then we see a price crossover occurring right here. So I'd buy this asset right here. Let's see what will happen. The stop loss will go right outside the Bollinger Band. So this was the area where it went out. So I'll put the stop loss around here. We see this trade end up turning into a loss. Why? Because the stop loss was here. This went into a loss before it turned into a target profit. Mind you, if you put the stop loss a little lower, if you put the stop loss around here, this would still be a winning trade. However, I would have put the stop loss somewhere around here. So this trade would have been a loss. Let me give you another example. You're not seeing it appearing here. Note positions here. Actually, this was a potential trade right here. So although the RSI here did not go below the number 30, it wasn't very close. We see the price of the asset went outside the Bollinger Band. So you see a Bollinger bounce and then went back inside. We see a price crossover occurring right here. So I'd actually take this trade. I'll put the stop loss. I have put the stop loss below the wick of that candle. I'll put the stop loss just below the wick of this candle. I'll put the target profit higher because the size of my win must be greater than the size of my loss. So I'll put the target profit about here. And this trade will be a winning trade. Put the stop loss here. This trade would have been a winning trade. This trade would have been a winning trade. The price of the asset went outside the Bollinger Band, and then we see a price crossover occurring right here. Now, all of the RSI did not go into oversold conditions, as in the sense that it did not go below number 30. It went very close to number 30. So I would still implement a trade because I saw a Bollinger bounce occurring right here, and I also saw a price crossover occurring right here. So I place an order to go long, and I'd ride this trade all the way up. Mind you, I want to emphasize again that when trading stocks, I tend to prefer to go long, in the sense that I prefer to have a directional bias to buy stocks. Yes, you can go short, but I generally have a preference to go long. I generally have a preference to enter orders to buy. I tend to go short when I'm trading currencies. I also tend to go short when I'm trading commodities. Let me give you another example. So we're not seeing much conditions here. Now we're seeing conditions to go short here because the RSI went above the number 70, but I tend to have a directional bias to go long. So I want to see the RSI going below the number 30. So I will not enter a trade on this chart here. Look, we see opportunity right here. The RSI went to the number 30, actually went to the number 29.75. So it went below the number 30. The price of the asset went outside the Bollinger Band. So we see a Bollinger bounce, it went back inside, and then we see a price crossover occurring right here. A price crossover occurs when the price of the asset crosses the moving average. So a price crossover occurred here. I'll place the stop loss just below the wick of this candle. Carry this target profile a little way up to ensure the reward is greater than the size of the risk. And this trade ends up being a winning trade. Now this daily chart will await 1, 2, 3, 4 days. 4 days, and this trade would have gone into profit. This is how we trade based on technical analysis. So if you're trading based on indicators, I have a strategy to trade based on indicators. I use Bollinger Bands, I use moving averages, and I use the relative strength index. I use these things to filter out the 4 signals. I wait for a Bollinger bounce. I wait for the price of the asset to go outside the Bollinger Bands, then go back inside the Bollinger Bands. I want this to be supported by a relative strength index of going below the number 30 or going close to the number 30. And then my entry point is right here when there's a price crossover. And when you trade based on that, you can enter a trade right here and the price of the asset can go up. Now, when I trade based on these indicators, when I trade based on this strategy, majority of my trades end up being a win. So although the size of my win generally is greater than the size of my loss, these trades tend to be very good trades. These trades tend to be high probability trades that tend to be winning trades rather than losing trades. So the majority of the trades end up being winners, and the size of the wins end up being greater than the size of the losing trades. So this causes these trades to be winning trades overall. So I end up being a winner overall. In other words, the size of my winning trades end up canceling out my losing trades. So I end up being a winner overall. So this is how we need to trade the financial market. You do not trade by guess. You do not trade by VAPs. You do not trade based on subjectivity or emotion. You trade based on fundamental analysis, or you can trade based on technical analysis. In this video, I show you how to trade based on technical analysis. You can trade on chart patterns, or you can trade based on indicators. Now, there are many chart patterns and there are many indicators. You should not trade on every single chart pattern available. You should not trade on every single indicator available. You should choose a few chart patterns and trade on these chart patterns only. You should choose a few indicators, develop a strategy based on these indicators, and trade on that strategy only. If you trade on every single chart pattern, and if you trade on every single indicator, you will be inconsistent. It will be almost analogous to guessing. You need to implement a strategy and you need to stick to that strategy. You need to define specific rules. You need to have rules for entry. In other words, when these conditions occur, I'll enter a trade to buy or to sell. You need to have rules for exit. In other words, when these conditions occur, I will close this trade. I'll either close this trade in a profit or I will close this trade in a loss. If you do not trade based on a rules-based strategy, you will be guessing, you'll be gambling. You do not want to guess, you do not want to gamble. You want to trade systematically and to systematically pick off profits over time of the market. So we covered a lot of content in this lecture today. This is Dr. Don Charles. Thank you for listening. We will cover more content in next lecture. Stay tuned for more.